The investor who never loses, but never wins. Introduction. At first glance, an investor who never loses money seems disciplined, cautious, and intelligent. They avoid crashes, stay away from volatility, and prioritize capital preservation above all else. But over time, a hidden cost emerges. Zero loss often means zero growth. This research explores the psychology, structural consequences, and long-term financial impact of being an investor who never loses, yet never meaningfully wins. 1. The illusion of safety. 1.1 Loss aversion and psychological comfort. Behavioral finance research by Daniel Kahneman shows that humans experience losses more intensely than gains. As a result, some investors structure their entire strategy around avoiding any drawdown. They prefer cash, low-yield savings accounts, short-term government bonds, capital guaranteed products. The emotional payoff? Stability. The financial trade-off? Stagnation. 1.2 The inflation trap. An investor who earns 2% while inflation runs at 4 to 6% is not technically losing money nominally, but is losing purchasing power every year. For example, if inflation averages 3% annually, $100,000 loses nearly half its purchasing power in about 24 years. The portfolio balance may look stable. Real wealth quietly erodes. 2. Structural causes of zero risk investing. 2.1 Trauma from past crises. Investors who lived through the 2008 financial crisis, the dot-com bubble, often overcorrect by avoiding risk entirely. The market becomes associated with danger rather than opportunity. 2.2 Volatility confused with risk. As emphasized by Warren Buffett, volatility is not the same as risk. Short-term price swings are uncomfortable, but long-term failure to grow capital is the real threat. 2.3 Over-diversification into mediocrity. Extreme diversification can dilute upside. Too many small positions. Excessive hedging. Constant rebalancing into safety. The result is a portfolio engineered to avoid pain and engineered to avoid meaningful compounding. 3. The mathematics of never winning. Consider two investors over 25 years. Investor A earns 2% annually, never loses. Investor B earns 8% annually, experiences occasional 20 to 30% drawdowns. After 25 years, $100,000 at 2% $164,000. $100,000 at 8% $685,000. The difference is not intelligence. It is tolerance for volatility. Compounding rewards patience with risk exposure. 4. The hidden cost, opportunity risk. There is a concept rarely discussed. Not taking risk is itself a risk. Avoiding equities means missing exposure to productive assets, companies that innovate, expand, and generate real economic growth. Over decades, wealth historically accumulated through ownership of businesses, not through holding cash. 5. The emotional comfort zone. The never lose investor often values sleep quality, stability, predictability. These are valid priorities. However, financial markets operate on a principle. Return is the reward for bearing uncertainty. Remove uncertainty, remove return. 6. Is capital preservation always wrong? No. Capital preservation is rational when time horizon is short, liquidity is required, risk capacity is limited. The problem arises when a long-term investor with decades ahead adopts a short-term defensive posture. Time horizon mismatch creates silent underperformance. 7. The paradox. The investor who never loses often feels successful because they avoided crashes, they avoided panic, they avoided regret. Yet years later, they realize their purchasing power stagnated. Their peers outpaced them. Compounding never truly started. Conclusion. The investor who never loses money may avoid emotional pain, but also forfeits financial progress. In long-term investing, the goal is not to avoid volatility. The goal is to survive volatility long enough to benefit from growth. Safety without growth is preservation. Growth requires exposure to uncertainty. And sometimes, the biggest financial risk is trying to eliminate risk entirely.